You have probably heard this argument 100 times. Real estate is the safest investment, or stocks always win long term. Or maybe someone in your family swore by one and dismissed the other completely. But nobody ever showed you the actual math. Not the headlines, not the motivational quotes, the real numbers. What happens to your money over 10, 20, 30 years, depending on which path you choose? That is what this is about. Let us start with real estate. You find a property worth $200,000. You put down 20%. That is $40,000 out of your pocket. You take a mortgage for the rest. Now, here is what most people focus on. The property appreciates. Historically, real estate in the United States has appreciated at roughly 3 to 4% per year. On a $200,000 property, that sounds solid. But your actual return is not calculated on $200,000. It is calculated on your $40,000 down payment. If that property grows to $270,000 over 10 years, you made $70,000 in appreciation on a $40,000 investment. That is leverage working in your favor, and it does not stop there. You are collecting rent every month. If your rental income exceeds your mortgage, taxes, insurance, and maintenance, that difference is cash flow, passive income, money arriving while you sleep. Real estate also gives you tax advantages almost nothing else can match. Depreciation deductions, mortgage interest write-offs, the ability to defer capital gains through a 1031 exchange. These are not small details. They are wealth-building tools hiding inside the tax code. So why would anyone choose stocks instead? Because the stock market has returned an average of roughly 10% per year over the last century, accounting for inflation closer to 7% in real terms. That number comes from the S&P 500, 500 of the largest companies in the United States, growing, compounding, and reinvesting profits year after year. Here is what $40,000 looks like in the stock market over 30 years at 10% annual return. It becomes approximately $698,000. No tenants, no toilets, no 2 a.m. maintenance calls, no property taxes, no vacancies. You simply let compound interest do what it has always done: turn patience into wealth. But wait, go back to the real estate example. That same $40,000 down payment on a rental property, combined with leverage, rental income, and tax benefits, can easily outperform that number, if managed well. The math changes completely depending on 3 things: location, leverage, and what you do with your cash flow. A well-chosen rental property in a growing city with consistent tenants can generate a total return, appreciation plus cash flow plus tax savings, that beats the stock market over a 20-year period. But a poorly chosen property in a stagnant market with high vacancy and maintenance costs can destroy wealth just as easily. This is what nobody tells you. Real estate rewards the active investor, the one who researches markets, manages properties, and builds systems. Stocks reward the patient investor, the one who sets up automatic investments, ignores the noise, and lets time work. Neither is universally better. They are different tools built for different people. Warren Buffett, arguably the greatest stock investor in history, has said that a simple S&P 500 index fund beats most active investment strategies over time. Yet some of the wealthiest people on Earth built their fortunes through real estate. Robert Kiyosaki, Sam Zell, Donald Bren, the list goes on. So what is the real answer? The math says stocks win on simplicity and liquidity. Real estate wins on leverage and cash flow. And the truly wealthy do not choose one, they use both. But if you are just starting out, here is the most important truth. The worst investment is the one you never make.
Time in the market, or time in the property, always beats timing the market or waiting for the perfect property. Your future wealth is not determined by which asset class you pick. It is determined by whether you start and whether you stay consistent long enough for the math to work. Because the real competition was never real estate versus stocks. It was always your future self versus your current excuses.